Hello and good afternoon. Welcome. My name is Camilla Avant, and I'm the Director of Diversity Programs at Color. I'm so excited to welcome you to our Color Conversations today in the first installment of Color's Future of Black Wealth series. Color is continuing its work to discuss issues that impact you with engaging thought leadership content, programming, highlighting diverse leaders, and empowering professionals of color with events targeting personal and career development. So if you want to learn a little bit about us, and you can always see what we're up to if you follow us on our social media hashtags. So I'm sharing that with you right now. You can follow us on Facebook, LinkedIn, Twitter, and also on Instagram. And then we are also showing all of our great content and past and future events on our website, colormagazine.com. So just a little housekeeping. Move through the slides here. We ask that you just be present. I know there's a lot going on. We're all juggling so many things, but we just ask that you try to avoid distractions the best way you can. This webinar will be recorded, so that way you can revisit the information at your convenience and go back to some things that you might have missed to refresh your memory. Kindly put yourself on mute, which will help avoid distractions as well as our speaker goes through her presentation today. And there will be a Q&A with this presentation. We ask that you put your questions in the chat box, and as they come up, our speaker will do her best to answer most of your questions. So I'm sure you have some great questions for her here today. Today we'll be focusing on money matters for women. We have a seasoned finance professional, Medina Jett, JD, MBA, who will present her presentation today, Manage Your Credit to Be a Money Boss, and she will give you tools for financial responsibility. I'd like to share a little bit about her today. Medina is currently the founder and CEO of Jett Speaks, LLC, and also Integrated Compliance Solutions Group, LLC, abbreviated ICS Group. ICS Group is an international compliance firm that provides legal and compliance services to Wall Street firms throughout the US, London, and Africa. She is a former securities attorney turned litigator in private practice. Medina joined the Aetna Law Department, where her focus was on employment law and race relations at the company. She returned to securities law and became the VP and Deputy Chief Legal Officer and Chief Compliance Officer at Cigna Investments, and later ascended to the role of SVP and Chief Compliance Officer at Prudential Retirement, and then also at the Hartford Group Benefits. Medina has been a champion for diversity her entire career, serving on hiring and diversity committees, along with task force focuses on the hiring and retention of Black lawyers. During the pandemic, she moved to launch her newest endeavor, Jett Speaks, LLC. She is able to pursue her passion to inspire and empower professional women of color. Jett Speaks focuses on 4 verticals: career development, entrepreneurship, financial literacy, and diversity consulting. Through speaking engagements and an individual and group coaching managed by the Jett Speaks team, Medina inspires women and people of color with her story and provides them with the skills, strategies, and unwritten corporate rules they need to excel in their career. Medina is a graduate of Wesleyan University, Georgetown Law School, and she holds an MBA in finance from the University of Connecticut Schools of Business. She is also a graduate of the Goldman Sachs 10,000 Small Business Program at Babson College. Medina resides in Atlanta, Georgia. Please welcome Medina, and we'll have Medina take it away and start with her presentation. Looking forward to all that you will share.
So good afternoon, everyone. I want to first give you a little bit of background about Jett Speaks. As Camilla mentioned, I started Jett Speaks several months ago in the midst of this pandemic. And really, it's a culmination of my 30-year career in corporate America, where I see such a need for African-American women to excel and to take a higher place among the corporate ranks, and also a need for corporations to do a much better job recruiting, retaining, and developing Black female leaders. So I focus on people of color and women We take a top-down, bottom-up approach where we are talking to women and people of color about how to excel professionally as well as financially. And then we're working with companies to help them create more diverse and equitable workspaces. So my focus overall is helping people of color close the wealth gap. We do that professionally because our careers are our greatest asset, and that's the way that we're going to improve our wealth and give us assets in which to invest really to close the gap. And then we also focus on financial wellness because that is so key to people of color starting to take our rightful place as power brokers in this country. And so focusing on financial wellness is what we'll be talking about today, specifically as it relates to credit management. Poor credit is such a huge issue in the Black community, and it stems from a number of things. It starts with, the basic fact that if you don't have a lot of money, you're going to have a hard time managing what you don't have a lot of. Financial stresses, financial pressures is one of the most common reasons why relationships fail, why people end up having stress that manifests into physical ailments. And so dealing with credit positions us to do so much in this life in terms of being able to live a well-balanced life, being able to buy a house, buy a car, have someone to live, provide for our families. And your credit score is just so critical. So we're going to be talking today about how do we do a better job managing our credit score in a much more strategic way. So a look at some of the disparities that exist in the credit sphere. If you look at the number of, or the percentage of people who have access to credit cards, and access to credit cards is a result of having a credit score sufficient to be approved for a credit card. 15% of white people don't have access to a credit card compared to 32% of African Americans. So our rate of being denied access to a pretty much a financial staple is more than double that of white people. So there's a lot of room that we have to improve in that respect in terms of building out our credit capability so that we can have access. For Black people, they took a look at 60 cities and looked at the median credit score among those 60 cities. In 50 out of 60 cities, Black people had credit scores, the median credit score was below 660. Now, for those of you who know something about credit, a score below 660 is going to mean that you're probably going to be denied a car note, you're going to be denied a mortgage, or if you are provided credit, you're going to have an exorbitant credit score because of the credit risk associated with someone with this credit score below 660. They looked at those same 60 cities, and white people, there in only 4 of those cities were the median scores of white people below 660. So think about that. There is a huge gap right there in terms of our credit scores, which results in Black people being subjected to proprietary lenders, where they're lending at rates that are just so high and so ridiculous. But when you don't have access to credit through regular channels, we're forced to go to predatory lenders, pay exorbitant interest rates, which costs us even more money for the same items like cars that other people have. We are so much more likely to have insufficient credit histories with which to even generate a credit score. So the number of Black people who are what we call credit invisible is much, much larger than any other demographic. And that results from us not having bank accounts. If we don't have a bank account and we're cashing our checks at cash checking facilities as opposed to establishing a financial foundation at a banking institution, we're less likely to get a credit card if we don't have a bank. We're less likely to pay our bills with a check and to pay our bills on time if we don't have a bank. And if we don't have a credit score, and we don't have a banking institution, we're not going to start to create a credit history. And those people are what we call credit invisible. When you're credit invisible, the credit agencies are unable to even start to establish a credit history for you. So how do we manage our credit score? First, develop a credit history and start to manage that number. So a little bit about what a credit score is. And some of this may be information that some of you already know. I know we're dealing with a pretty diverse audience in terms of your level of sophistication. So bear with me if this is information that you already know. A person's financial history is packed into a 3-digit number. This 3-digit number is absolutely critical in terms of your ability to get approved for credit. It is indicative of your credit risk. So the higher your credit score, the more likely you are to pay your bills on time, and the more likely a lender is to issue you credit, because they can take faith that based on your credit score, you're going to pay that debt back. FICO is the primary company that uses statistics and algorithms about your credit payment history to determine what your credit score is. Your FICO score is the most common credit score, but there are some other companies out there that also do the same thing. But your FICO score is primarily the one that lenders look at to assess whether they're going to issue you credit, and if so, what the credit or what the interest rate is going to be based on the amount of credit risk associated with lending money to you. So there are 3 different credit reporting agencies: Experian, TransUnion, and Equifax. These 3 credit bureaus or credit agencies take information that's generated by your FICO score, and then they publish your score. Across the 3 different credit bureaus, there may be factors that one looks at versus the other. One may update your credit history more recently than the other. So you're going to have some disparities in terms of the credit score across these 3 different credit bureaus. But for the most part, they're going to be in the same ballpark. And for the most part, lenders will take an average of your highest score versus your lowest score. So if you've got one score at 700 and one score at 650, and you may have TransUnion somewhere around 660, they're going to take the average of those and say, okay, your credit score that we're going to attribute to you is somewhere around 680. So that's generally how it works in terms of your credit score. So when you show up at a car dealership and you pick out the car that you would love to have, and you know that you can probably make the mortgage payments based on your salary, you then have to apply for the loan. And that's where the tricky part comes in terms of what is your credit score. They run what they call run your credit. And then based on your credit score, they will come back in the room and say, okay, based on your score, this is what we're willing to do in terms of your interest rate, and this is what your monthly payment would be. And that's generally when people have the first instance of how important your credit score really is. So to summarize, it's used by your lenders to determine your loan eligibility and the interest rate that you'll get. It impacts your ability to rent an apartment. They're going to look at your credit score to say, gee, is this somebody who we can anticipate will pay their rent on time? When you're buying a car, getting a mortgage, getting a business loan, everybody's going to be looking at your credit score. So the higher your score is, the lower your interest rate is going to be. So you're sitting in that car dealership and you're looking at a credit score of 800, they're going to come back in with some very, very low rates. Some even may have 0% interest because they want your business and they know that you're going to pay that loan back. On the flip side, if you come in with a credit score that's fairly low, say you have a 600, they may either deny the loan altogether, or they may come back with an interest rate of 20%. So what does that mean to you in terms of having a low score versus a high score? You'll save money actually with a high credit score. So if you're looking to borrow $10,000 or to get a loan for $10,000 for a car, and your credit score is so high that you have a 2% interest rate, that's going to mean that over every year that you have that $10,000 loan, you're going to pay $200 in interest, 2% of $10,000, right? If you have a low credit score, they may come back with a 20% interest rate. That means for every year you have that $10,000 loan, you're paying $2,000 in interest, right? So you're paying 10 times as much for that same loan that somebody is going to pay who has a high credit score. So it is vitally important to manage your credit score more than you manage anything else, because that's going to enable you to get the best deal, to pay less money for the same exact item. And having that high credit score is going to mean that you are a money boss. You're going to be able to walk into a car dealership, talk to a mortgage broker, and basically get what you want because you've demonstrated that you are a money boss and you're responsible with your credit. So the credit score ranges. Credit score, you can start it goes from 300 up to 850, right? Almost nobody has a 300. Usually people who are considered to have bad credit or a low credit score are somewhere over 580 up to 650 or so. Once you get a little past 650, around the 670 area, you're considered within the good range, which means you're likely to be approved, but you're still likely to pay a higher interest rate than someone who is in the very good category. So people who have 740 and above are going to get a better rate than the people in the 680 to 740. And then once you start to hit that 800 mark, that's when you're really calling the shots. And you're walking in and saying, yes, I want that car, and here's my credit score. And they're going to, jump all over themselves trying to sell you a car because they know that you're somebody they want to do business with. Credit score matters. In terms of how do we manage that credit score, the first most important thing is to make all of your payments on time. A lot of us struggle with remembering when a bill is due. I always advise our clients to make sure you're setting up a spreadsheet that details every bill that you have, when it's due, and when you're going to be mailing that check. Luckily now we're in such an age of technology where you are able to set up electronic bill payments. I encourage everybody to do that. Set up the electronic bill payment, so even if you don't remember to pay your bill, it's set up and it's going to get paid automatically. More times than not, people suffer poor credit, not because they don't have the money to pay their bills, but because they're negligent about paying their bills. And they think, oh, a few days late's not going to matter. Those slow pays all add up to bringing down your credit score. Another tip, never exceed your credit limit. So if you take out a credit card and you've got a $3,000 limit on that credit card, if you exceed that limit and you charge something on that credit card, it's probably still going to go through, but now you are going to have exceeded your limit. You're going to incur exceeding credit limit fees, and that's also going to show up as an overextension of credit on your credit report. Lenders don't like to see that. When they see that, that says to them that you are cash poor, meaning you don't have the cash, so you're putting things on credit. And what that further says to them is that if you're cash poor, how are you going to manage paying for yet another loan or another credit card? So that is a problematic issue. Try to keep your credit card balances below 30% of your credit limit. And that basically means that your credit utilization score is going to be very impactful on your overall credit score. So what that says to a lender is if you have a $3,000 credit limit and you're only using $1,000 of that in terms of what your revolving credit on that credit card is, that says to a lender, one, that you're managing the credit effectively. Two, that even though you have available credit, you don't need to use it. That gives them the sense that because you're not using that credit, you're not in dire straits, so to speak, in terms of your cash flow. When you have a situation where you're exceeding that 30% use of your credit limit, the easiest way to address that is to call your credit card company and request an increase in your credit limit. Increasing that credit limit means that you're going to bring down your credit utilization without having paid down your debt, right? So you're really looking at taking your credit limit from a hypothetical 3,000 up to 5,000. Now, the fact that you have $2,000 in credit on that card, it's going to be a much less percentage because it's now 2,000 out of 5,000 as opposed to 2,000 out of a total 3,000. Does that make sense? So don't use that increased limit, but use it. It's a strategic play to be able to bring down your credit utilization, which improves your credit score. When you've paid off an account, don't close the account, because even though you paid off a credit card, leaving that credit card open is going to give you that credit limit, which lowers your overall credit utilization. What it also does is increase your credit history. So part of your credit score is comprised of how long you've had credit. If you leave that credit card open, you're going to get the benefit of whenever you open that credit card. If you close that account, you basically take away the credit history that you've established with that account, and that doesn't do well for you building your credit history and the amount of credit that you have outstanding. And then this is obvious, but I'm going to say it. Avoid bankruptcy. A lot of people get overextended in credit, think that solves their there's someone not on mute. If you could all mute yourselves, that would be helpful. So avoid bankruptcy, avoid foreclosures, and avoid collections. Collections are when you have an outstanding, not even necessarily an unpaid credit card, but any amount that you owe someone. For example, you owe a hospital. You may owe a company that you've ordered something from that you never made payment on. Whatever it may be that you owe, typically it's a situation where you haven't asked for credit, such as a credit card or a car payment, but it could be other things that you owe, like I said, like a hospital bill, for example. You don't pay it, it goes into collections, and it shows up on your credit report as a collection. Doesn't really get to show up on your credit report before it becomes uncollectible, because you never asked for that extension of credit. So it's not like a credit card where they're reporting every month on whether you paid your bill on time that month. Avoid like the plague collections. Call that hospital or whoever it is, that debt collector, and ask to enter a payment plan. Once you enter that payment plan, you create a way for you to reasonably and very manageably handle that debt before it gets to the point of collections and before it reflects poorly on your ability to pay your bills and reflects poorly in your credit score. Next tip is to never co-sign a loan for somebody. There's so many people now who are suffering from low credit scores because, unfortunately, in a lot of our communities, we have people who are either credit invisible or they suffer from low credit scores. So what that means is they're unable to walk into a car dealership and buy a car, even though they may need a car to get to work and everybody needs transportation. So they look to those people in their communities or in their networks who do have a good credit score, those people who are more responsible with their credit. Those people tend to be the ones that are called on to co-sign for their friends, for their boyfriend, for their husband, for their spouse, for their family members, for their parents, cousin, whoever it is that's asking you to co-sign a loan for them. My advice is don't do it unless it's someone that you would be willing to make their payments for them. If you're not willing or able to make those payments for somebody, if they should stop making those payments, if they should lose their job or whatever happens, then you should never co-sign. I recently co-signed a car loan for my daughter. My daughter's 19. She wanted to buy her first car. We went into the car dealership, and because she's so young, she's pretty much credit invisible. She didn't have enough established credit to give them comfort that she was responsible with making the car payments. Even though she now has a job, she's able to make the I think the car payment's like $200 a month. So I co-signed her loan for her, which brought her interest rate from 16% down to 2.5%. That's a benefit of when you should co-sign. Because if my daughter doesn't have money for her car note, I know I'm going to make the car payment. So I'm willing to save her money by bringing down her interest rate by using my good credit score to help her. That's an instance where you should co-sign, where it's a child or it's a parent, someone that you would want to help lower their payment and help them out, and also someone that you have control over whether they make that payment or not. So what I did, I am a joint card holder on my daughter's bank account. I can see if she's made her payment. I can go into mobile banking and basically take money from her account and move it over to pay off her bill. So in that instance, I was very comfortable co-signing. For anybody else, not so much. Last tip is to use an app to review your credit report regularly. There are so many apps out there. Credit Karma is one. MyFICO.com is another. Credit Genie. There's just so many of them that you can download. Some are free. Some have a small nominal fee. I think MyFICO charges like $20 a year to monitor your credit score. Use those apps because they provide you real-time tips as to how to increase your score. They will say things like, if you have a credit card, one extra payment next month will bring you within that 30% utilization rate, which will increase your score by about 20 points. The apps tell you things like that. So use them and make sure you're taking advantage of the data that they're able to provide to you in terms of how to effectively manage your credit score. So the credit score, these are the things that go into how your 3-digit number is compiled. First one, and most important, is your payment history. Are you paying your bills on time? Do you have foreclosures, bankruptcies, or collections on your credit report? Do you have a history of consistent slow pays, meaning you're paying it, but every month it's coming in late? That will impact on your credit score. So of your entire credit score, 35% of it is going to be directly related to your ability to pay your bills on time and make sure that you don't have any other indicators of inability to pay, such as foreclosures and bankruptcies and collections. 30% is going to be based on the amounts that you owe. We call it credit utilization. So 30% of your score is going to be based on how much of your available credit are you actually using? How much do you actually owe people? Like I said, keep it below 30%. If you need to, call your lender and try to request an increase in your credits, in your credit limit. That's going to lower your credit utilization number. And as you can see, that is a huge part of what makes up your credit score, 30%. So that's going to be critical. When you look at what do you need to do to improve your credit score if you see your score is not where you need it to be, always the first thing that you can take immediate action to address is to pay off some of your outstanding debt, which lowers your utilization, which will have almost an immediate impact on your credit score. Your payment history is a harder problem to solve because once you've missed a payment, it usually stays on your credit report for 7 years, which is quite a long time and not much you can do about that. But your utilization, you can see an almost immediate impact. The next is your length of your credit history. Not much you can do about that. The only thing I would recommend is start immediately. If you don't have credit cards, you want to make sure that you're establishing your credit history as soon as you possibly can. Open up a credit card, even if you don't have intention of using it. And I'll talk later about why it's good to actually use it. But the time to start trying to establish credit is not when you finally saved up enough money to buy that house and you go to a mortgage broker and you find out what your credit score is. You want to start managing your credit score now so that when you're ready for that major purchase, when you need to present yourself to a lender, you can go in comfortably and confidently that you've managed your credit score and that you're in a great position to get the best interest rate possible. The next area is the type of credit that you have. And I'm going to talk a little bit about this later in the presentation, but you want to be able to show that you can manage several different types of credit. So what do we mean by that? Credit card is what we call revolving credit. You have a certain amount that you're entitled to use for credit. You charge it, you pay it off, you charge some more, you pay it off. It's continually revolving. So long as you pay it down, you still have access to that amount of credit. Some people have had credit cards for 40 years. It's revolving. You continue to be able to have access to it, as opposed to closed-end credit, which is not revolving. It's a car note, it's a mortgage, it's a student loan. You take out a loan for a certain amount of money, you pay it off. Once it's all paid off, it's done. You can't then buy another car because you paid down that car note. It doesn't work that way. You were approved for that amount of money. That's a closed-end account. Lenders want to see that you're able to manage closed-end credit versus revolving credit versus a mortgage versus a line of credit. The more different types of credit that you have, the better. But at least make sure you have the revolving credit and the closed-end credit. Those are the two core pieces that they want to see that you're able to manage effectively. And then next is new credit. If you're taking out a lot of credit cards all at the same time, or you're buying a car the same time you just opened a credit card, same time you just took out a new student loan, all too much new credit raises red flags for creditors, and they wonder, well, what's going on? Why are you taking out so much credit? Are you having some cash flow issues, loss of a job, or whatever that might be? And so that accounts for 10% of your credit score as well. That is sort of the overarching umbrella of how your credit score is comprised. The average credit score in 2019 in this country was 709. If you have a credit score that's below 709, you should be asking yourself, what do I do to fix that? Bankruptcies stay on your credit report for 10 years. Once they're on, there's not much you can do about the bankruptcy. So you're stuck with that part of it. And likewise, late payments, collections, repossessions, those types of things will stay on for 7 years. Not much you can do about those. So, but there are some things that you can do. Make sure you're reviewing your credit report on a regular basis, filing a dispute if you see anything that's in error. You can also write in to the credit reporting agency an explanation of something that's on your credit report. So any lender that looks at your score, they will see in the remarks that you've submitted an explanation as to what occurred there. You lost your job. You had a medical emergency where you just incurred a medical debt that you weren't able to pay and it went into collections. Any explanation can be added to your credit score that may help mitigate what your score actually is. Pay off debt to lower your utilization rate. I talked about this before. Either pay off the debt or increase your credit limit to address any issues with your credit score, and that will help. Pay off debt in collection. So if you look at your credit score and you see that you've got a matter that went into collections, and sometimes this is what really gets people. You may have a $20 parking ticket that went into collections because you never paid the parking ticket. And then because you didn't pay it, it shows up on your credit report as a unpaid debt, a collections issue. And it's sitting out there and it's dragging down your credit score, and it was for $20. It could be a cell phone bill that you moved and never got the final bill and you never paid it off. And it's on your credit report and you don't even know it. Look for things like that you can quickly call the phone company, say, gee, I see this is in collections. I never even got the bill. how do I take care of this and clear it? Once you clear it, you won't clear the fact that it was in collections, but you will clear the fact that it's now been resolved, it's been paid. So at least your lenders can see that you are responsible enough to not leave unpaid debt out there. And that also has an impact on your score and can raise it as well. Next slide. I don't know why my cursor's not moving now. Oh, why is my presentation not moving? Hold on one second, guys. Okay. So we're next going to move into using credit, using credit effectively. But before we do that, we're going to take a pause here and see if there are any questions at all on your credit score and how to manage that. And then we're going to move into how do you effectively use credit cards.
That's some great stuff, Medina. Thanks a lot. We do have some chat questions in the chat box. One of them is from Christina Santana, who said, I've heard that it's best to use open but unused credit card accounts every once in a while instead of just letting the account sit. Is this necessary?
That is absolutely true, because when you're building your credit history, you want to show that you are able to manage credit. If you have a credit card and you never use it, how are you showing that you know how to use credit? Not just have credit, but use credit. So what I always recommend is using that credit card every month. The more you have established that payment was made timely, the better it is for your credit score. So what I recommend doing is using that credit card for fixed expenses that you have anyway. For example, you know that you're going to have to put gas in your car. Rather than use your debit card to pay for gas, use your credit card to pay for it. And then you just pay the credit card bill off. You're not spending any more than you otherwise would have. You're not incurring any more expenses than you otherwise would have, but you're showing that you are using credit and paying off credit. Using credit and paying off credit. And the more you're able to do that, the more your credit score, those critical 3 numbers, start to rise. So don't just have a credit card. And we're going to talk more about that in this next segment in terms of, we're going to talk about how do you use credit strategically to build your credit score. So great question. Thanks for that.
Great, thank you. Another one is coming from Kira Pimpensi. How do student loans impact the ability to land a mortgage or a car note? Does it at all, or is it just about the credit score, assuming you can afford the purchase and are employed to be able to do that?
So student loans impact your situation several ways. One, if you're not making timely payments on your student loan, that can be devastating to your credit score. And that's really what gets so many young people started out on the wrong financial footing, because they come out of college, they've got all this student loan debt, they have never had any type of financial literacy awareness. And so they figure, okay, I can't make that payment this month, and they just don't. It ruins their credit score. So make sure that you're paying those student loans on time. The other way that student loans will impact your ability to get a mortgage is what we call your debt to income ratio. So if your outstanding debt is higher than, I want to say 40% of your total income, that's going to impact your ability to get a mortgage, because the mortgage companies want to know that you're not cutting it so tight that you barely have any money left over after you're paying your debt, you're paying your living expenses, you're paying for recreation, and you've got your mortgage on top of all that. So they want to make sure your debt is below a certain number, and every lender has their own percentage, but sometimes it's within that 30 to 40% window. You want to make sure that your debt to income ratio is right. Sometimes the student loan can throw off your debt to income ratio. So if you have a student loan, make sure that your credit card balances are as low as possible. Pay off those credit cards before you go apply for that mortgage. Make sure that you're keeping that debt to income ratio low. And the student loans, because of the way they are and they're so long, a lot of them are huge and long lasting, they can bring down your debt to income ratio and impact your ability to get a great rate on an interest rate. But the most important thing is to make sure that you treat your student loan like you do taxes. You cannot discharge student debt just like you can't discharge taxes, your tax liability. Always pay those first and foremost.
Great. And you mentioned about young people. When is the best time to start advising young people about their credit?
It is never too young. So what I always advise is talk to your children when they are very, very young. The minute you start giving them an allowance, talk to them about credit, being credit worthy. So what I like to do, and what I've done with my kids, is to have them establish debt, right? I'm going to give you $2 to buy that, but when you get your allowance on Friday, I want you to pay me back at least half, and then you pay me back the next half the next Friday. And so they start to manage credit at a very young age where they're saying, gee, I've got my allowance of $5, but gosh, I got to pay mom back one of those dollars. I only have 4 left. If they then go buy something with that $5 and they haven't paid me back, there's a lesson to be taught there in terms of the importance of paying your bills. Pay your bills first before you then go buy things for yourself. So it's never too young, but when the age when you want to formally introduce them to credit, I would say is when they have their first job, to get them signed up with a credit card where they're able to charge and then pay it off. Charge and then pay it off, and talk to them about the importance of not using the credit card to buy things that they couldn't otherwise afford to buy with their cash, but using the credit card as a vehicle for things that they would otherwise have used for cash. That means they're not incurring any debt, where a lot of young people who don't use credit cards effectively end up paying for vacations and paying for clothes and handbags and things that they probably can't afford if they had to come up with the cash. So they see the credit card as somewhat like free money and a way to just buy it now and pay it over time. I always advise making sure you give your kids a lesson in how to effectively use credit. Use it strategically to build your credit score. Don't use it to buy things that you can't afford to buy. And so there's a huge lesson there. It boggles my mind why schools will teach courses in math, but they won't teach courses in financial literacy. It is critical in terms of just being able to manage your life, to understand how to use credit. So never too early, but I would say at least when they get a job, give them a credit card. What you might also want to do, which is another little trick that builds credit score, is add them to your credit card. When you add someone as an additional card holder in your account, they then inherit your credit history. Pretty cool trick. It only works well if you have a good credit score. If you have some credit issues and your score is a little jacked, you don't want to have your kid inherit that. But if you got a credit score that's over 700, that can boost your kid's credit score and get them already started with a credit history, where most people their age are credit invisible and they're just starting to develop credit. So add them to your account, their additional card holder, but don't give them the credit card. They never have to use that credit card to be listed as a card holder on your credit account and inherit your credit history and your good payment habits. So
that's great. Now we got a lot of questions about having these young kids using credit cards. So Crystal Haynes asks, so if an 18-year-old uses their debit card, which also says Visa, as a Visa, will they be building their credit?
Unfortunately not, because that's really not an extension of credit. A credit card is where you don't have cash involved and the company is actually extending money to you for your use. Using a debit card, even though it says Visa, that's just sort of the payment system behind the scenes of how that money gets from your account through the bank to the actual merchant. But a debit card is not going to establish credit because you're only using money that you have. You're not borrowing money for a purchase.
Got it. So when you add your young child or teenager to your credit card, does their credit history separate of that card, or does it affect your credit score?
It doesn't affect your credit score, not at all. So their credit score is still very separate from yours. Their credit profile is separate from yours. What you're doing is giving them the benefit of the score or of the credit history, the payment history for that credit card. So think of it as your credit history with this particular card that they're on gets ported from you and you're sharing it with them. All of your other credit history stays yours, right? But your payment history on that one card, you're able to basically loan and transfer over to for the benefit of your child or the benefit of a parent as well. I had my mom on one of my credit cards, my American Express card, for years, only because I wanted her to have access to capital if she happened to have some emergency. And unbeknownst to me, it boosted her credit score quite considerably because my mother and a lot of us have parents who are old school, right? They don't believe in being in debt. They don't believe in credit cards. But having her on that card boosted her credit score without her having to actually use it.
Great. And we'll take one more question. This is from Ayanna Crawford. And back a little when you talked about bankruptcy. I know there's some people who have different views of bankruptcy. They say, oh, if I file bankruptcy, it doesn't really, I got a clean slate and it starts me all over. So Ayanna's question is, can you file bankruptcy? And I know, how does that, I guess, the ripple effects on building new credit after you do file bankruptcy?
So I always say filing bankruptcy should be your very last resort, because even though it's like you get a clean slate, you don't have to pay back debt that you voluntarily incurred, it is devastating on your credit score because lenders are going to look at your credit history, they're going to look at your credit report and say, gee, all of these other creditors extended credit to this person, and what did she do? She discharged it in bankruptcy, which basically means you get a free pass. You don't have to pay your debt. And then all of your creditors have to write that off. They don't get their money back. Nobody wants to deal with somebody who is so irresponsible that they don't get the creditor doesn't get their money back. So while the person who files bankruptcy is sitting pretty, they no longer have all of that debt looming over their heads. If you are trying to buy a car, buy a house, get a mortgage, you're going to have a very difficult time because that bankruptcy is going to stay on your credit report for 10 years. If, on the other hand, you have so much debt that it is impacting your level, your ability to live what I call a healthy life. If it is stressing you out and you have bill collectors and collection agencies ringing your phone and you see no way out, no way to enter a payment plan with your creditors, no way to cut back on your spending to be able to pay off this debt, no way to go to a credit, what do they call it, credit repair company to try to get some help with lowering your interest rates or reaching some type of payment plan or payment arrangement with your creditors to get your credit within manageable chunks. If you've got no other options, then sure, file bankruptcy, but just go into it knowing that for 10 years, you're basically going to have your hands tied in terms of being able to make any type of big financial moves. And for some people, that's fine with them. Some people, they go into it not really realizing the impacts. And so just make a knowing decision when you make that decision.
Great, thanks. We'll let you move on to the next half of your presentation.
Okay,
Thanks.
how are we doing for time? Because I can't see the clock and I want to
We
make sure.
are just 4 minutes short of 1 o'clock.
Okay. All right, so we'll go through this the next 20 minutes. All right, so some of the benefits of using credit is that it improves your cash flow. You have a credit card, you don't get paid for the next another 2 weeks, but you need groceries. And using that credit card to pay for things that you would have otherwise paid for, and then when you get your influx of cash, you go back and pay. So basically, it allows you to have the benefit of cash over that full amount of time, even though the way you're paid is in huge lump sums at periodic intervals. So spread that. It allows you to improve your cash flow over time. It also builds your credit profile, which we just talked quite a bit about in terms of managing your credit score. Using that credit card, but use it strategically to improve your credit score. You also earn points towards rewards or cash back when you're picking your credit strategically. I, for one, happen to love Home Goods, Marshalls, TJ Maxx, right? So what credit card do I have? I have the TJX card. That's an example of a revolving credit. It's things that I'm going to be buying anyway. I'm going to shop at Home Goods whether I have a TJX card or not, because that's just my store. So I use that credit card. Every time I use that credit card, I'm earning points towards rebates for my purchases. So I'm getting, in a sense, cash back every time I use that card. And the benefit of that card is I don't just have to use it at Home Goods or one of the TJX stores. I can use that card to book flights, for gas at the gas station. I can use it to pay my bills. I can set it up with bill pay. So everything that I'm charging on that card, I make sure that I'm charging things that I would otherwise pay for. And it essentially allows me to go into Marshalls once a month with $100 of free money for what I want to buy. That's how you strategically use credit. I'm not paying any more than I otherwise would have spent, and I'm getting free money. So use credit cards strategically for points, rewards, that kind of thing. Credit increases your ability to make investments. So one of the benefits of being able to use that credit is that when you want to buy an investment piece of real estate property, for example, you can actually use your credit card or get a mortgage or a line of credit to help you do that. So having that credit history and that available limit where you're able to write a check, cash transfer, is a very powerful tool if you want to start making money moves like that. And then when used properly, credit offers you financial freedom. There's not much that you can't do when you have a great credit score and you've been using your credit wisely. So those are important benefits of using credit. So folks who say, well, I don't like being in debt, I don't want to use credit, think of credit not as going into debt, but as a tool that you use to be able to do things that you want to do in this life. So we talked about the primary types of credit earlier, so I'm not going to go into this too much, but the lesson here is to just make sure that you're focused on both types of credit. Make sure that you're taking out hard loans like a car, and you're taking out revolving credit like a credit card or a store card, things that you can use indefinitely as you're paying off the debt. You continue to be able to have access to that credit. That's going to boost your score. Okay, before you apply for a credit card, these are some of the things you should think about. What's the interest rate, and is it reasonable? There's a huge range that you'll see with a credit card, and a lot of it has to do with your credit score, and some of it just has to do with the type of company that's issuing the credit. They just have higher costs, and so they pass those on to their consumers and they charge higher rates. Make sure that you're looking at that interest rate and you're comparing it to what other cards are offering, and you're comparing it to what other people are getting. So within your friend circle, you should feel comfortable saying to one of your friends who you know is pretty well established, what kind of interest rate are you paying on your credit card? Compare that to what you're looking at and make sure that it makes sense. A lot of times interest rates will fluctuate with the economy. It's a recession. Are banks pulling back? Are they more risk averse? Their interest rates may fluctuate. So make sure you're getting a good sense of comparison to make sure that what you're looking at is reasonable. Under what circumstances will your rate increase? A lot of times there'll be fine print that if you miss one payment, your interest rate will go from 6% to 26%. Make sure you're paying attention to that and you understand what are going to be those triggers to a higher rate and what's that higher rate going to be, and are you prepared for that in the event that situation occurs. Also look at, is there a grace period? A lot of times credit cards will give you a 5-day grace period or a 10-day grace period on your payment. I always say, forget the grace period, set that payment up to be made on the day it is due. So in the event something happens, mail gets lost, something happens with your bill pay system and your payments don't go out that month, you can identify the problem and correct it before you pass the grace period if you pretend you don't have a grace period. If you're using your grace period before your payment's being processed, if anything goes wrong, now what? Now you're late, right? So make sure you're not using that grace period the wrong way. And then look at the penalty fees. A lot of credit cards will have fees where they're charging you an extra fee. If you exceed your credit limit by $1, they're going to charge you an extra $25. They may have fees if you are late with a payment. It could be a fee of $25 late fee, or it could be a percentage of the outstanding debt. Look at what those penalties are and make sure that those are reasonable and something that you're willing to live with should that situation occur. And then how much is too much in terms of credit? How much can you comfortably afford to pay each month? That's a very important question in terms of how much debt should you be incurring? What percentage of your monthly income should be allocated to credit card payments? One rule of thumb that I always use is your credit card debt should never exceed 1 month of your net income. So what that means is if you make $50,000 a year, your net income is going to be somewhere around $3,000 a month. You should never have more than $3,000 in outstanding credit debt. And of course, that is depending on what your overall credit limit is. Because if your credit limit is less than 9, then your outstanding debt should be less than 3, right? Because you always want to be under that 30% of your overall debt. But as a general rule of thumb, if you are charging more than 1 month's worth of income, you're living above your means and you're trying to keep up with the Joneses and you're using credit the wrong way. So think about that. Take a look at your monthly net income and then assess for yourself, are you using too much credit? So some credit card pitfalls is falling for the marketing hype, those 0% interest rates without realizing that after 4 months or 6 months, that interest rate is going to skyrocket more than the market norm. Not shopping around for the best rate. Look at other credit cards, look at the rates that, like I said, people that you trust that are financially established, look at the rates they're paying and make sure you're doing the due diligence to make sure you're opening the right card with the right company. Look at those fees. They can be enormous, particularly for someone just starting out. If your minimum payment is $25 and now you have a penalty fee of $25 on top of that. Avoid making only the minimum payment. A lot of times with credit cards, if you're only making the minimum payment on those credit cards, the length of time that it's going to take you to pay off that debt is going to be years, sometimes 10 or 15 years if you're only making the minimum payment. Make sure that, one, you try to pay it off every month. But if you can't pay it off every month, pay something more than that minimum payment that's due, or you are going to be stuck in a cycle of barely paying more than the interest, because the minimum payment is really the interest with a little bit of the premium tacked onto it. It's what credit cards companies want. They want you to pay the interest and to keep that outstanding debt going as long as possible because they make money off the interest. you don't want to make all of those payments and just give money to the credit card company without being able to take some big dips and carve out the outstanding debt. Avoid taking a cash advance. Typically, taking a cash advance on your credit card is going to involve a much higher interest rate for your cash advances than the rate for just regular charges. That should be the last stop or last option if you run into an issue where you need cash. And then avoid maxing out your cards. We talked about that. If you're exceeding that 30% utilization rate, or if you exceed your limit, which is another issue that can impact your credit. And avoid sharing your credit card. So I shared the tip about adding someone as additional card holder, but I also gave the precaution, but don't actually give them the card. Add them to it so they can start to build their credit history. But once you share your credit card with somebody, you're essentially making yourself liable for any charges that they put on that card. It's going to be impossible for you to say, yeah, but that wasn't my charge, that was my boyfriend's charge. Doesn't work that way. You're responsible for that. So someone says, let me use your credit card, or even your debit card falls into that as well. Never authorize somebody to use your credit card, because you're going to be stuck holding whatever they incur on that card. So some tips. Use your credit cards to pay off your fixed monthly expenses. It's the easiest way to build your credit. If you know that your insurance bill is $200 a month, set it up so that your car insurance is paid for by your credit card. And then instead of paying your car insurance company, you pay the credit card. Same expense, same out-of-pocket cost, but you're establishing credit as opposed to having that money just come out of your checking account. Same with groceries, gas for your car, all of those fixed expenses. If you're not putting those on credit cards, you're doing this all wrong, because you're going to build your credit history and you're going to get points from using that credit card that you can use for other things. Use credit only for necessities. So, it's so easy to say, oh, I can just charge that. That suit is really, really nice and I don't have money to pay for it, but I can just charge it. I have a credit card. And people say, I have money on my credit card. No, you don't have money on your credit card. You have debt that you can incur. But if you're looking at using your credit card for something that you can't afford to buy right now, you're not only looking at the cost of that item, but you have to add on, what is all the interest that I'm going to pay on that credit card in order to pay for that item? And then ask yourself, is that item going to be worth it if you consider how much interest you're going to pay over the years to pay that off? Pay off your cards with higher interest rates first. I mean, that may seem obvious to a lot of you, but if you're paying 15% on one card and 8% on another, obviously make sure you're making at least the minimum payment on that 8% card, but all of your discretionary cash should be thrown at that higher interest card. Get those higher interest balances paid off first. That then reduces your outstanding debt, and then you're able to pay the cards with the lower interest rate. Why does that make sense? Obviously, you're going to be paying more money for the debt on the higher card. So you want to pay those off so you're not paying those higher fees and paying more for those cards. And then again, I said avoid cash transfers. You're going to pay much higher interest rates on those. And then use credit if you can earn more than the interest charged. So what that means is, even if it's something that you don't have cash for immediately, but you need to get credit for it, you need to buy it, what you might do is compare, what is it going to cost me if I put this on a credit card versus what am I going to earn on this money if I don't? So let me give you an example of that. I want to buy a piece of real estate, and it's going to be a rental property. And I know that buying that property and renting it out is going to earn me 50% on my investment, right? I don't have the money for the down payment on the house, but I know that if I put it on my credit card, I'm going to pay 6%. that's an issue. That's an instance where you want to use credit because it's going to help you make money. If I don't use credit and I'm not able to buy that house because I don't have enough cash in my bank account for the down payment, I'm going to lose out on that ability to make that 50% IRR because that's how much I'm going to gain from being able to rent out this house and earn money. So yeah, I'm going to run to my credit card and I'm going to take out that $10,000 in credit because I'm going to apply it over here and buy this property, and it's going to make me 50% on that money. So does that make sense? That's when you're using credit to your advantage. You're taking credit because you can earn more than the interest that you're going to be paying on the credit based on the investment that you're making. Perfect example of how you can use credit strategically to make yourself money. Okay. So that wraps up the use of credit, and we'll take questions around use of credit cards.
Great. We have a number of questions in here for you, Medina. So let's get started. Actually, this is someone who mentioned credit, but they also went back to their 401 IRAs as well. So let's see. What's the difference between having good payment history and a good credit card history? Is there a difference?
Yeah, there is a difference. Your overall payment history is what matters. Credit card history feeds into your overall payment history.
Precisely.
You can have a great payment or credit card history in terms of consistent payments on your credit card, but you could also, at the same time, have a very poor history of paying your rent on time, right? So your credit card payment history is great, but your rental payment history is pretty bad. And both of those feed into your overall credit score. So one feeds the other. Certainly, if you have a great credit card history, odds are that you're also responsible in other aspects of your life. And so your overall credit score is going to be pretty good. But there are instances where someone has great credit card history. They may not realize that landlords report to credit reporting agencies as well. And so they figure if they only have a certain amount of money, they're going to make sure they're paying their credit card on time. And, oh, I can pay the landlord late and it doesn't really matter. Not true. And so making sure that you're being responsible in all aspects of your life is what's going to be most impactful to your credit score, but certainly having a good credit card history is going to be a big part of that.
Great, thank you. And so here's one from Yvonne. Should I use a loan against a small amount of my 401k to pay off my home mortgage with the current laws where the home deduction is minimal?
Should you use an IRA to pay off your home mortgage? That is really going to depend on the interest on your IRA, and it's going to depend on the interest on your mortgage. And typically what I would say is you're going to compare the two interest rates, and then you also want to look at your taxes historically to see what is the actual benefit of having that mortgage to your overall tax picture. It could be that if the mortgage is very small, it didn't really have a huge influence on your overall tax outcome and tax liability, but the interest rate on that small amount of money may be high, in which case, sure, I would take money out of an IRA to pay off a high interest mortgage. But if it's a small interest mortgage, I wouldn't worry about it so much. So a lot of it's gonna depend on your specific situation in terms of how much interest you're paying and what your tax deduction and your tax picture looks like.
Great. So how do you protect your credit during the COVID pandemic? And what's the best way to deal with making payments if you're facing COVID-related financial challenges? Say you lost your job, you've been furloughed, salary reduced, and you're struggling. What are some tips you can give for that?
Sure. So there are a couple of things you can do. I would say first is reach out to your lenders. A lot of them are totally aware of obviously they're totally aware of the situation, but a lot of them are making concessions during this period of COVID-19. So you first want to call your lender, explain your situation, and ask what your options are. Some of them, I know mortgage companies are allowing people to go into some type of mortgage deferment where you're not responsible for making your mortgage payments during this period of COVID-19, but after say 3, 6 months, whatever the period of deferment is, those payments either get tacked on to the back end of the mortgage, or you have to make those payments, over the time, over the next year of your mortgage payments. So calling your mortgage company to find out what those different options look like is a very good thing. That's probably the first move I would make. Secondly, I would call credit card companies and I would either ask for some type of deferment arrangement like that, ask for reduced interest rates, because lowering your interest rate means you're going to have lower payments. And being able to get those payments lower, a lot of credit card companies are realizing that a lot of people are going through very challenging financial times, and they'll be willing to make those types of concessions because they figure if they can lower your interest rate to allow you to continue make your payments on time, they're still getting paid. And a lot of them are very concerned that a lot of folks aren't paying credit cards, which then starts to have an impact on the financial, stability of our financial institutions. So try to defer your payments, lower your interest rates, ask for payment plans if you can for outstanding debt that you have. You might also want to do things like call your car insurance company and say, it's COVID, I don't have a job, we're on lockdown, I don't even drive anymore. Do something about my insurance premium because my risk profile looks a lot different than it was if I were driving 20 miles a day to go to work. Those types of things you can do, and a lot of companies would be open to that, just considering that we're in a different world now, and car insurance companies are making a ton of money because very few of them have really had any significant reductions in premium, but their claims costs have been so drastically reduced because there's just not as many cars out on the road these days. So those are some things that you can do to try to cover yourself and make those ends meet.
Those are great. Here's another question. Angela, how do you find out the interest rate on your credit card? And then her second question is, if you have student loans to pay, what is the percentage of your income that you should be putting into your 401k?
If you have student loans to pay?
Yeah, so I guess she's trying to figure how you juggle putting money into your 401k in addition to, paying some of your student loans as well.
Okay, so the first one, how do you find out what your interest rate is? Typically, when you get your credit card statement, they are required to disclose not only what your interest rate is, but how long it will take you to pay off that credit card debt if you're only making the minimum payment. There should be a box on your credit card statement with that specific disclosure. You can also find out your interest rate by calling your credit card company and say, what's my interest rate? No matter what they tell you is your interest rate, say, I want to lower my interest rate. A lot of times just by asking to lower your interest rate, they'll lower your interest rate. A lot of times the interest rate that you start with is sort of an introductory rate because you're a new customer. They want to get comfortable that you're paying that bill. Once you've had that credit card for at least a year, call them back and negotiate a lower rate. And that's assuming you paid the credit card timely within that year. If you haven't been responsible with it, sometimes your rate just goes up as opposed to you being in a position to negotiate it down. But definitely call them, find out what it is, and then say you want it lowered. Okay.
Great, thank you. There's a lot of questions in regard to using the 401k. So here's another one.
Yeah,
Would
so
you?
I don't think I answered the second part of that first.
Oh, right.
That was, how much should you be putting into your 401k when you have a student loan?
Student loans, right.
Consider a student loan to be just part of your cost of living, if you will. So think of a student loan as that piece that comes off the top automatically before you even consider what's left. I used to think of my student loan as the cost of my education and the cost I have to pay to be able to collect the salary that I was collecting. The student loan gets paid first, sort of like taxes. They get paid first. After you pay your student loan, then you say, how much do I have if I'm taking a really, really conservative look at all of my other living expenses? So you want to figure out what is the minimum amount that you can spend on groceries? What is the minimum amount that you can spend on recreational activities? What is the minimum amount that you can be spending on clothing, for example? And then once you come up with that budget of what's the minimum amount, and be reasonable. I mean, you don't want to say you can spend $20 a week on groceries and that's not reasonable. Come up with a minimum reasonable amount, create that monthly budget, and then you look at how much is left. Out of that, how much is left, you should be dividing up between your company 401k, your savings account, because you want to have some money in a savings account that's more liquid than having to tap into your 401k. You want to use that as a bank account or a rainy day fund. But you want to at least put enough money into your 401k so that you are taking full advantage of your company match, right? So if your company matches up to 5%, you want to make sure that you're putting in 5% so that you get that full company match. Anything else after that is going to be up to you based on how quickly you want to see your retirement fund escalate, but at least make sure you're getting the full amount of the company match, and then make sure that you're putting something into savings for what I call the rainy day fund, which typically is 6 months worth of income. If you should lose your job, make sure that you can live for 6 months before you're homeless. And that's a problem that a lot of us don't really factor in. We live paycheck to paycheck and we don't have that rainy day. So when the rain comes, and I guarantee you at some point in your life, the rain's gonna come, make sure you have that fund to shield you from the rain for at least 6 months.
Great, thank you. We'll do one more last question. Do you recommend opening up a 401k or a Roth IRA when your company requires you to contribute to your pension?
Is it asking 401k or Roth?
Yes, or a Roth IRA.
I would say I think it's easier if you're opening up a 401k with your company from an administrative standpoint. If you happen to have a financial advisor that you trust, opening up a Roth would be a good idea, and then have that financial advisor manage your assets there. The benefit of a 401k is that your company is going to be putting up what tend to be very good investment options that you can choose from in terms of managing your 401k. They tend to have the providers in that retirement plan, the funds that you are able to invest in. They tend to be more hands-on in terms of providing investment education that you can take advantage of when you're participating in that 401k plan. So I would say that's probably the best way to go. And you also, typically companies will offer a company match for assets in your 401k plan. So I would say at least make sure you're getting the full advantage of the company match and the education that's provided, and then think about opening a Roth on top of that. But you don't want to open a Roth instead of that.
Thank you, Medina. You provided a lot of information and very detailed and very in-depth, and we definitely appreciate you sharing your knowledge and all of that wealth of experience, especially as we move more into some of the pension IRA questions. So definitely appreciate you sharing your information with us. So again, I want to remind everyone to go to jetspeaks.com to learn more about the things that Medina is doing. She's offering now soon, and she's launching her first group coach, GPS 201, which is going to be in September, on September 15th, as we move into Career Month. She has been doing a lot of things to, again, support and really give out good content for financial planning for diverse professionals, and she's doing great work. So really definitely go and join her on her website to see what she's working on. And we really want to thank you for sharing your knowledge and your experience with us today, Medina.
It's been my pleasure to be here, and I hope you guys got a lot out of it. And yeah, it's been great. We're doing great work at Jett Speaks, not just in financial literacy, financial wellness, but in career development. And as I said at the beginning, we're launching GPS, a Black Woman's Guide to Professional Success. It's a coaching group for women who want to be boss in their professions. It's going to be a 6-week in-depth coaching session on how to position yourself to get to that next level in your career. So look for more information on the Jett Speaks website, www.jetspeaks.com. And I hope to engage with all of you at some point in the future.
Thank you, Medina. And again, we will also share this video link with you so you can go back and refresh and get some more information that you might have missed, because it was impactful. It was a lot of stuff in that short period of time. So we definitely we'll get that out to all of those who had registered and maybe those who have missed out. So please follow Color on our Facebook, Instagram, Twitter, and LinkedIn to learn more about our upcoming events as well, and our continuing of the Black Wealth series. Our next event will be next Friday, which we will focus on manifesting your future. And we'll have some talented entrepreneurs and media professionals talking about how they move their vision into achieving their goals. So you can go to our website, colormagazine.com, for more information. And thank you all for attending again, and be safe and take good care of yourself. Have a great afternoon and a great weekend. Thank you so much.
Great. Bye.
Bye-bye.